All right, so welcome to Learning Objective 4. Now, in this chapter, you're introduced to merchandising companies that sell goods, right? Buy and sell goods. Prior to this chapter, we've basically focused on service companies. So the income statement that you know is relatively basic. You have revenue, you have expenses, and then your net income. Well, that's something that continues here. There are companies that use something called a single step income statement that show all the revenues in one batch, all the expenses in another batch, and then income. But what you're going to be introduced to in this objective is something called a multi-step income statement, which really gives you a breakdown of things differently than a single step. And personally, it is something that you need to know, and it's one of my favorites. We don't have to worry so much about comprehensive income. We'll focus on the single and multi-step. So again, here is your single step income statement showing your revenue is listed first here. Your expenses are then listed second, and then your net income. So this is what you were basically used to seeing from all those service businesses that we studied in chapter 1, 2, 3, and 4. A couple of things that you might note that are different. Number one is that revenue is called net sales. And I think I might have told you that from the previous learning objective. You need to know what net sales are, right? So that's all the sales revenue minus the sales returns and allowances, minus the sales discounts, if any, right? So that's your net sales. And like I was telling you, most corporations that are in merchandising, and this company REI is in merchandising, and it's sort of like it's a sporting goods outdoors type store, so it's like Dick's or kind of Cabela's or Modell's or, things like this. And so here they report their revenue as net sales. And again, here's all the different expenses that are listed. And you notice one that is introduced to you in this particular chapter, which is, again, merchandisers sell inventory to customers. They sell products. When they buy the product, it's their inventory, it's their asset. When they sell that inventory, it can be expensed as cost of goods sold. So you have here the cost of goods sold. Again, it's the only expense account you've learned so far that doesn't actually have the word expense in it. And so cost of goods sold is an expense account in essence. And then of course your net income is reported. Here is the income statement for REI for two concurrent years. One is the fiscal year. This is a fiscal year ending January 3rd, 2015. And then the previous fiscal year actually ended a little bit earlier on December 28th, 2013. But this is basically a 1-year period, and this is a previous year. Net sales are reported first. This looks like, and we're going to focus more on the 2015 numbers, or this particular column. It looks like $2,217,000 here, until you realize that the statement is in thousands, which means to get the real number, you're going to have to add 3 zeros to all of these numbers here. And so that 2,200,000 comes 2,217,000,000 in sales. It's pretty sizable amount of sales. A little over 2 billion the previous year. So again, when you look at the previous year to the current year, at least on the statement here, it's an increase, almost a 10% increase in sales, which for a retailer is really good. It's really good. As you see, the biggest expense, regardless what year, the biggest expense that merchandising companies have is the cost of their inventory. Cost of goods sold will be the number one expense you will see on all merchandising income statements. Okay. You would think, well, maybe it's labor. Well, in the service business, it's labor. Labor is the number one expense that service companies have, but not merchandising companies. Merchandising companies, their biggest expenses. Cost of goods sold, which is selling their goods to you. The second is the labor costs. Okay. And so here they have a sizable number of expenses that are totaled up here in this number, 2,173,000,000. And when you compare the total revenue with the total expenses here, their revenue number is larger. So they have a net income, they have a profit for that year of $44 million, 44,118,000. So a pretty good year. And you compare the profit from the previous year to this year, it's more than double what the previous year was. So we can look at it as a very good year in terms of REI. But is it? Well, one of the things you're going to be learning about in this part of the chapter is some financial analysis, some ratio analysis. Well, I mean, if the customers, remember, the net sales come from customers. If the customers are giving you $2.2 billion in revenue, and you're only keeping 44 million as a profit, what percentage of that did you actually keep? And so you're going to be learning about those types of questions, how you can actually answer it in that way. It's actually a lower amount than you would think. Okay. And so you're going to be looking at that very soon. Another thing that is really important is the multi-step income statement will give you the gross profit. And remember, gross profit is the difference between the net sales and the cost of goods sold, right? You didn't see it on the single step income statement. You could calculate it, but you didn't see it outright. On the multi-step income statement, it's given to you. It's actually calculated for you. So that's one very, very good thing. Another really good thing is they actually give you the profit. Remember, the word income and the word profit is the same, right? Net income, net profit. It's the same. So these are interchangeable words. Remember, earnings is also an interchangeable word as well. So here you have their profit from the operations. Now that's a very interesting thing because some businesses have a lot going on. And what I mean by the operations, this is the main operation of the company. So for example, and this is a good example, you might have been to a Walmart Supercenter, maybe the one in Fishkill, maybe the one up there in, I think there's one in Kingston. And you walk into the Walmart and you'll notice right away, and Walmart's main business, of course, their main purpose of operating is to sell the goods that are in the store. Now, the fact that you walk in and you see a McDonald's there, the fact that you walk in and there's a hair, a beauty salon, there's a bank, there's other types of things, right? Well, they don't own the bank, they don't own the McDonald's. They're actually renting the space out. They're making money as a landlord. Well, that's something else they can do, but it's not the main operation of Walmart. Walmart's main operation is selling goods. So wouldn't you want to know the profit specifically from operating the main part of the business, which is selling goods, from all the other stuff that they do, and they do other stuff. So it's only the multi-step income statement that actually tells us what the profit is from operating the business, the main business, the core business, not all the other stuff. And then, of course, they give us the net income. So you'll see this coming up here. This is for REI. Again, this is a big retailer like Dick's or Modell's or Cabela. And here are the three things that we just talked about. So one is they give you the gross profit here, right? The gross profit is net sales minus cost of goods sold. And that's important because remember, this is the amount of money left over from the customers, right, after they've paid for the goods that they sold to the customers. So a gross profit is a very important indicator. How much of the 2.2 billion that the customers gave to them do they still have after they paid for the goods? Well, 960 million, almost a billion. So not that bad, not that bad. Because this gross profit has to pay for all the other stuff before we actually get to net income here. So what we have here is the gross profit is that first thing that's listed here. The second thing that's very unique about the multi-step income statement is it'll actually give you the profit from operating the business. And for REI, just by operating the stores, they had a profit of 181 million 878 $1,000, almost $182 million from profits from running the store. And as you see from the previous year, that's a pretty large jump. Um, so that's really good. So how do you get from 181 million, almost 182 million in a profit from operating the company by selling the goods that are for sale to only a $44 million net profit? Well, that's because the company does other stuff. And this is true for lots of large companies. In addition to their, like I said, in addition to Walmart, their main business is selling products. But they also, as you see, clearly walking into the store, they're a landlord. You know, they're collecting rent from McDonald's for having that store there. They're collecting rent from the beauty salon. They might be collecting rent from other places where they have maybe banks or other stores in there. Um, and that's true. I mean, you've probably been into the Target or other, you'll see a Starbucks or sometimes you'll see something else. They're collecting rent from those companies there. So that's other income, other profitability that they have. And of course, they have expenses to go along with that. So what I really like about the multi-step is they break out the other stuff that they're doing separate from the main business. So what you got here is everything that's related to the main business here. Okay. And then this other section basically is all the other stuff that they are doing that they might be making money from. For our friends at REI, they're not making any other revenue, but they do pay out a large portion of their profit in the form of a patronage refund. Now, we would have to go and open up and research a little bit about what that is. But all I can see from this is that it's taking away a large share of that particular profit, right? I mean, if you go from almost $182 million profit, and after you pay out these patronage refunds, you're down to about $71 million of profit. That's a pretty good chunk of profit that's being basically expensed, right, from this statement here. So that would be curious to find out what that is. What's left, if this is their profit, they have to pay tax on the profit. Okay, they have to pay taxes on any net income that they have. So they show what what the net income is, or the income before taxes. They will then make a provision for an income tax expense. Just because you see that they are expected to pay $27 million of that profit in taxes doesn't really mean that they do, because the tax code and the tax laws and the tax forms are substantially different. Well, they can be substantially different than the income statement. This is the form that we're using here. So, but they do have to estimate their tax to expense. And that's where you get the 44 million at the end. Okay. So again, how much, I mean, if customers gave you 2.2 billion and after it's all said and done, you're stuck with 44 million as a profit. Now, I wouldn't bark at 44 million at all. I mean, it's good compared to 18 million the previous year. But you know, what percentage is that? You know, I'd like to know of every dollar the customer gives you, what are you keeping for you at the end of the day? So we're going to learn how to do that, and we do it easily through a multi-step income statement. Okay, and again, that third part is the net income, which is on all income statements. So your book goes ahead and explains all of this in more detail. Remember, I told you from last class, I'm sorry, you had to know how to get net sales. This number right here, net sales. Sales revenue, less returns and allowances, less discounts. The net sales is almost always the figure that's being reported on the income statement. Okay. This particular income statement is for our friends at PW Audio, which of course has been busy throughout this chapter, right? Cost of goods sold is listed. Here you have a gross profit. Here. All the other expenses for the operating of the company is subtracted out, and you have your profit from your operations. Profit from your operations. Then all the other stuff is shown. Now look for PW Audio, they have other things going on. They're earning, they have interest income, that's revenue. They sold off an asset and made a $600 gain. That's technically revenue. They had interest expense, and they had a loss from vandalism that they could write, or could expense that particular year. So all this other stuff doesn't have anything to do with them selling what they sell. But there are other things that happen in the company which they have to recognize either as revenue or an expense. Okay, so they have a profit, they have to pay taxes on that profit. Again, this income tax expense is an estimate, and then the rest is net income. Okay, and so your book goes ahead and explains each and every portion of that, including some examples of that other category in a little bit of detail, and your net income is listed there as well. But these are the multi-step income statement is a very important statement to know how to read. They have some basic multi-step income statements that they want you to prepare. I do not emphasize this. I might give you a portion of one or two here, but it's really no big deal. In this case, a multi-step income statement, you would start with, right, you'd have your sales revenue and your sales discounts to get your net sales. So net sales would be those two numbers. You start with the 462, you subtract out the 20. That would give you your net sales. What comes after that gives you net sales. Then you would take out your cost of goods sold. Net sales minus cost of goods sold will give you your gross profit. From your gross profit, all your operating expenses would be subtracted out, right? And that would give you, in many cases, your net income. Again, in this case, this particular company has some other stuff to report. Okay. And a tax rate of 25%. So again, it would show here, again, the net sales minus cost of goods sold gives you your gross profit. Take away those operating expenses, you get income from operations. Again, this is what we know in this. We know about gross profit from multi-step. We know about income from operations. They have that other category. Well, they had other revenue of 8,000, other expenses of 5, so it's going to add another 5,000 to the profits of that company that year. Gives them $113,000 of profit. They pay tax on that. The tax rate they gave you was 25%. That's their estimate, and that gives you the net income. So you have to know how to read it, as well as potentially do something very similar to this. In brief, this is not something I emphasize because you've already had a ton of income statements and balance sheets to do, but you might have a very short problem to just remember. All right, and again, we're not worried about comprehensive income at this stage. We're going to be dealing with that in intermediate accounting if you keep going. Learning objective 5 talks about how they keep track of inventory using a periodic system. Now, if you might remember from earlier in the chapter, there are two inventory systems. One that is very common called a perpetual inventory system. And the perpetual system is common because almost all stores computerize their inventory. They use the barcodes, they use other types of things to scan things in, scan things out. When you buy something at the register, the products are being scanned, or you hear the infamous, boop at the supermarket. And so, that's all perpetual stuff. There are some businesses that have to they don't have a computerized inventory system. They do basically everything by hand. Maybe that's because it's very small and they can do it. They have the time to do it. Or it's very specialized and it doesn't make sense to have a complex inventory system. It might be easier to do things differently. So they literally have to physically count how much inventory they have periodically. So again, periodically means in many cases whenever they do their financial statements, which are monthly. Certainly quarterly will be another financial statement, and yearly. Um, and so there's no running account of inventory or cost of goods sold. They actually have to calculate it. So that means that they do a physical count at the end of the period, say the end of the month or the end of the year. Let's just do it by the month just to make it easier. So this is how they set it up. At the beginning of the month, they find out how much inventory they have. That's the beginning inventory for the month. Then throughout the month, as you know, stores don't like to have empty shelves. They keep buying goods and putting them on the shelves for sale. So they add to that beginning inventory, they add the cost of all the goods they purchased and put on the shelf. That gives them all the goods available for sale to customers that month. At the end of the month, they go ahead and count what's on the shelf. They do an ending inventory. Okay. And the difference is assuming the whatever is not in the store is not in ending inventory. So they're going to assume they sold it. And that's the cost of goods sold. Now, it's very important to understand the inventory number is important because it's an asset. Matter of fact, it's a current asset. And of course, we call it beginning and ending, but literally the account name is simply inventory. Okay. Um, and then the cost of goods sold account, as you know, is an expense account. So at the end of the period, say it's the end of the month, they know what their ending inventory is, which is important because that's going to show up on the balance sheet as an asset. It's a current asset. And when they do their income statement, they're going to know the cost of goods sold because they've calculated it this way. And that's going to be an expense account. As you know, it's the first expense account that's listed on a merchandise for a merchandising company. So this is just showing you how they do it. And I just did it from a month, right? Beginning of the month, this is what's in the store. You're buying more stuff. That's all the goods available. At the end of the month, you count up what's left. That's your asset that goes on your balance sheet. Whatever's not there, you've assumed you sold. Cost of goods sold is an expense. And that's basically all they do. This is what it looks like. This is a more formal sheet here of how they calculate the cost of goods sold. This is for PW Audio. They had a bunch of inventory at the beginning of January. This is for the year here. So they start with this inventory. Looks like they made a bunch of purchases. They did some returns and discounts on those purchases. So the net purchases was 307,800. But to get those purchases to them, they had to, it cost them freight, cost them transportation. That, remember, that increases the cost of the inventory, which is why we add them together. So the total goods purchased was 320. When you start with 36,000 and you add another 320,000, you have a total of 356,000 of inventory available for sale through the year. At the end of the year, in this case, December 31st, you count what's left. They have $40,000 worth of inventory left, which means they sold the difference. The 316 is the cost of goods sold. And so this is how it looks more formally. And your do it exercise for number 5 is basically the exact same thing here. In this case, we have Aerosmith's company. Their accounting records show what's going on at the end of December. And then here's all the different accounts that are listed. And then they want you, they use the periodic system, so we have to physically count this stuff. It's a real pain in the behind. The first thing they want to know is what's the cost of goods purchased. So, you know, the purchases minus the discounts and returns plus the freight. That's that. And then they want to know the total cost of goods sold, right? So again, everything starts with your beginning inventory They're beginning with 18,000 of inventory, right? Then they bought these purchases, but then they got some discounts on it. Plus they sent some back. So we subtract those out, but they had to pay for freight, pain in the butt there. When you add the 18,000 of beginning inventory, I'm sorry, when you add the purchases with the freight and take away the discounts, that's going to be your goods purchased. Once you get your goods purchased, you add it to your beginning inventory. And that's going to be the total goods available for sale. Subtract out what's left in the store, and we have to assume the rest you've sold, so that becomes your cost of goods sold. So again, the purchases thing here simply is that first thing. You bought this stuff, you sent some back, you took some discounts. We subtract it because it lowers the cost of inventory. But then we have to pay for freight. So the way we look at it in accounting, your inventory costs more, and so we add it to the inventory. That's where that comes from. 160 and 18 is the 178. That's all the goods that are available. At the end of the period, you looked around, you only had 20,000 of this stuff left. That means you sold the rest, cost of goods sold. Any questions so far? You guys are okay? All right. Well, just chime in or type anytime. The very last thing in this chapter is financial analysis, financial ratios, and there's two that are very, very common. As a matter of fact, you'll hear about these if anyone watches or has watched Shark Tank. It's been a popular show. It's been on for many years now, so it's pretty likely that you might be interested in that and have watched it. But they talk about margins all the time, and you're going to learn a little bit as to why that's important. So the first, there's two ratios we're going to be learning about. The first one is called the gross profit rate. I learned it back in the day as the gross profit margin, but they mean the same thing. And basically, when you look at your gross profit and you compare it to your sales, what's the percentage? That's basically all it is. So whatever the gross profit is, you divide that back over net sales. That's your gross profit rate or gross profit margin. A lot of people would use the term markup to indicate margin as well, or gross profit rate. So how it works is it's a very simple formula. Gross profit divided by net sales. Okay, that's the gross profit rate. So these two numbers you can get right from the multi-step income statement. It starts with net sales, and then they calculate the gross profit for you on the multi-step. But what if you didn't have a multi-step income statement? How could you get the gross profit? Well, you start with the net sales and subtract out your cost of goods sold. And what's left is your gross profit. So either way, you can figure out the gross profit, and thus you can figure out the gross profit rate. Let's take a look at our friends at REI, Recreational Equipment Inc., for 2014. They had a gross profit of 960 million on sales, net sales of 2.2 billion. So their gross profit rate was 43%. I'm just going to round it to 43%. Well, what does that mean? Well, for every dollar, remember the net sales is what you're collecting from customers. So for every dollar the customer gave you, after you paid for your inventory, after you paid for the cost of the goods, you were able to keep 43% of that dollar as your gross profit. So basically 43 cents out of every dollar of sales is your gross profit. Now, is that good? We'll find out. Okay, because remember the gross profit, it has to cover all the other expenses before you get to net income. So let's see how they do, right? It's about the same from year to year for REI. Well, again, one of their biggest competitors is Dick's Sporting Goods. And Dick's Sporting Goods, when they compared their gross profit to net sales, they had a gross profit rate of only 31.3%. I'm just going to say 31%. Well, what does that mean? Well, for Dick's, every time they sold something and collected, for every dollar they collected from the customer, um, they had to pay literally about 69 cents of that to cover the cost of the inventory, cost of goods sold. And 31% of that dollar, or 31 cents of that dollar, is their gross profit. As you see, it's significantly lower than REI. Does that give REI an advantage? Well, it depends. I mean, gross profit is important, but more important is your overall profit at the end. How is the industry doing? Now, the word industry, in essence, means firms that are doing the same type of business. So when you look at Dick's Sporting Goods and REI, these are um, sporting goods and outdoors retailers, right? So if you look at that group as a whole, that's the industry. Their gross profit rate is sitting at 34%. So that means that they are keeping 34% of the customer dollars in sales as a gross profit, which also you can tell that their cost of goods sold is about 66 cents for every dollar. 66% of every dollar is going to cover cost of goods sold. That leave them with 34% left. So Dick's is similar to the industry. It's not very far off, but REI is significantly higher than the industry. And so let's see if that actually pays off in a better profit at the end of the day. Well, that's what a profit margin tells us about. It's again, when I grew up, we used to call it net profit margin. Um, but basically speaking, it looks at the net income compared to the net sales. Okay, the net income compared to the net sales. And that is a very important for overall profitability. So again, when you look at profit margin, that is simply the net income, the net profit of the company for that period divided by the net sales for that same period. Okay. So basically, how much, when a customer gives you a dollar out of your net sales, how much are you keeping as your profit when all your other expenses are paid for? That's another way to look at it. Well, let's go to REI in 2014. As you saw, REI's profit in that year was $44 million, a little more than $44 million, on sales of over $2.2 billion. Well, that means they had a 2% profit margin, which meant, here it is, the kicker, which meant that of every dollar the customer gives them, which is their sales, after all the expenses were paid, they kept 2% of that dollar, or their profit was 2% of every dollar that they basically collected from customers. 2 cents on a dollar is a relatively low rate in this industry. Okay. As you see, the industry here is running at about 5%, and Dick's Sporting Goods is keeping a little over 5% of every dollar. So that means that Dick's Sporting Goods, when they sell things to the customer and the customer gives them that price, that sale, right? They're keeping a little over 5% of that as their net profit after they pay for everything, all the other expenses. And so that makes Dick's Sporting Goods a significantly more profitable company than REI, even though when you looked at gross margin, REI had a huge advantage there. They had a really big advantage. Well, obviously, this is more important to owners, to stockholders. They want to make sure that net income is as high as possible. And it looks like Dick's is bringing home more of every dollar as profit than REI is. Okay. And then we have those two ratios are part of the Do It exercise 6. So you have the gross profit rate. So that's the gross profit compared to the sales, net sales. And you have your profit margin, which is your net income compared to your sales. So here you have Rachel Rose. Information for 2 years are provided 2017 in the first column, the year 2016 in the second column. The gross profit rate, right? Well, as you know, the gross profit rate is the gross profit divided by the sales. Well, they don't have the gross profit here, but you can simply calculate the gross profit because it's net sales minus cost of goods sold. That's the gross profit. Then you put that number back over net sales. So again, 80 minus 40 will give you 40. Throw that back over 80. You got 50%. Right. The next thing, and they do that for 2016 as well. And then they want to look at the profit margin rate, which is the net income compared to your net sales. So here you have an $18,000 profit for 2017. Put that over 80,000, and you're going to have much more than 20% return on that. So, and again, you're going to do a little bit differently for 2016. That's your profit here. That's your sales. So again, to do the gross profit, your book gives you the answers here. For 2016, the gross profit rate is gross profit over sales. And as you see, for both years, it's still a 50% gross profit rate. When you look at it from the profit margin perspective here, you've got net income of 18,000 over 80 in sales, 22%, 22.5%. Versus 16.7%. Again, the instructions will tell you to round. It's usually to 1 decimal point. I will tell you that. So if you do get a bigger number here, just make sure you're capping it and to 1 decimal point here. So it looks like they did much better in 2018. Look, that's 2017. They had less sales, but they were more profitable. Right. So, it's not the size of the company that is going to matter a lot to owners. It's just really how profitable the company is. And in this case, it showed that Rachel Rose, even though they sold less, they were able to do a lot of things better because they had a much higher profit margin at the end of the day. And again, if you watch, and I know a lot of you probably do watch Shark Tank, you're going to see these questions all the time. I mean, if it's not from Mr. Wonderful, Kevin O'Leary, you're going to hear it from Mark Cuban, or you're going to hear it from a few of the others. What's your margin on this? What are your costs? What are you selling it for? There's your margin. There's your margin. They ask these questions all the time. They also do other types of valuations as well that we do in finance. But so it's pretty common to know these terms, regardless, even if you're never ever going to set foot into another accounting class, or you're going to even think about learning or majoring in finance. Guess what? Everybody should know this anyway. Everyone's going to know this anyway. These are very important ratios.